Hello traders, welcome back to the Forex Geek channel where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the trading strategy that capitalizes on market gaps, those price void that occurs when markets reopens. You discover how to identify these gaps, you would understand why they form, and most importantly, learn a systematic approach to trading them effectively. Now, what do we understand about forex gaps? Before we dive into the strategy, we need to understand what forex gaps truly are. A gap occurs when market opens at a different price from where it previously closed, creating a void in price charts. These gaps typically form during the weekend transition as forex market closes on Friday at 5 p.m. EST and reopens at Sunday 5 p.m. EST. So this is an example of a gap in price. This is on Friday when market closed. As market closed on Friday, as you can see the timing, price then opened on a Sunday by 5 p.m. and you see there was a gap in price. What you are seeing here is a classical weekend gap formation. Notice how opening price on Sunday differs from the closing price on Friday. This gap emerge when major economic events, political development or unexpected news occur during the market closure. Three main factors create these profitable gaps in the forex market. First, institutional order flow. When large banks and financial institutions place substantial orders before market opening. Secondly, the economic data released that happens when the markets are closed. Thirdly, geopolitical events that shifts market sentiment over the weekend. So these are the things that causes the gap in price. Now look at the chart, you can identify three distinct types of gaps in price. Common gaps appear regularly and typically get filled quickly. Breakout gaps signal the start of a new trend, while exhaustion gap often mark the end of a trend. Understanding this difference is crucial for your trading decision. The most important aspect of gap is their tendency to get filled. Market statistics shows that an approximately 80% of all forex gap eventually close, meaning price returns to the pre-gap level. This high probability creates a reliable trading opportunity that we will explore in details. Now let's look at how the strategy works. Here is how we can capitalize on the strategy, on the entry rules. These are the entry rules, how we can enter such strategies, such gap strategy. Now the bullish gap, first of all we'll wait for the 15 minutes candle after the gap has formed. So I'm opening my 15 minutes chart. Let's look for where the gap in price was at. This is the gap in price. After we wait for the 15 minutes candle, we wait for the first 15 minutes candle after the gap has formed. So this is the first 15 minutes candle, and we would also ensure that the higher time frame aligns with the lower time frame. As you can see, the higher time frame, before we came here we were on the 1 hour time frame, and it showed us that we were in a bullish trend. Let's mark this area and we'll go to the higher time frame. Let's know what we're doing. We can go to 4 hour time frame, we can go to 1 hour time frame, as the case may be. You can see currently now price is showing a series of, it broke structure at this area. If you also want to use your SMA, you can see that it is swinging to the upside. Price is making a series of higher highs, higher lows here. That means we are actually trending to the upside. So this aligns with what our 15 minutes time frame was trying to tell us. So let's continue. Now the rule is, after we make sure that our 15 minutes candle has closed, we would enter a long position if the price continues to rise from the gap. That's in terms of a bullish gap. We notice that after our 15 minutes time frame, we notice that price continues to rise. We can quickly enter a trade from this area. We put our stop loss below. Now in case of a bearish gap, similarly we wait for the 15 minutes to close after the gap. The first 15 minutes showed a bullish candle, the second one showed a little bullish, but there was a sign of an exhaustion. We will check for the higher time frame to see if it supports the trend. And remember, the higher time frame, we look at the higher time frame in this example. Let's mark this area. Higher time frame, that's the 4 hour, 1 hour, as the case may be. As you can see, price has already shown us that it's ready to trend towards the downside. Currently price is giving us a series of lower lows, lower highs, and lower low. As you can see, even the momentum is showing us is towards the downside. So yes, we are on the right side of the market. We're in the right side of the market. So we'll go back to our 15 minutes time frame to know how we would enter our trade. The rule states that we would enter a bearish or a sell position. We would enter a sell position if price continues to fall after the gap. As you can see, price continues to fall after the gap. Immediately we see our bearish engulfing. We can also use candlestick pattern. We can decide to enter our trade. Then where do we keep our stop loss? For a bullish gap, for a bearish gap now, we set our stop loss above the high of the gap. This is above the high of the gap. That's where we set our stop loss. Then in terms of a bullish gap, we set our stop loss just below the low of the gap to protect us against unexpected reversals. We can also make use of the average true range indicator to determine whether there is an appropriate distance for our stop loss. But for the bearish gap, we just need to set our stop loss high above the gap, and we can also use the ATR to ensure our stop loss is neither too tight nor too loose. How do we do our take profit? We can put our first take profit at we can aim for the gap to be filled. This is where the gap is filled. This is 1:9.6. This is where we can aim for the first take profit, where our gap will be filled. If you look at the trade, you notice that the gap became filled at one point in the market. The second, let's look at the buying opportunity. Look at one point in time, market close the gap. So this can be our first take profit. Our second target can be, we can consider previous support or resistance levels as potential exit points. So we can target the low of this point, which is a previous support, or we can look further to target a lower support, as the case may be. Then our final take profit level, we can also make use of psychological round numbers. major price level, psychological round numbers, numbers that ends with 00, that ends with 50, as the case may be. If you see numbers on the chart, these are psychological level that price tends to respect in one way or the other. They can be used as ultimate target areas. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do well to not forget to subscribe, to like and share this video. Do turn on your notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and we'll see you in the next video.